Hey, welcome everybody to the 40 Finance channel. Checking in today with a live stream on a market day that's actually been pretty good, particularly if you follow the NASDAQ. You're up 1.27%, S&P at about 1%, Dow Jones at 0.65%. But it certainly hasn't been a smooth road across the board this year. But, generally speaking, I've been happy as big NASDAQ fan of where we've gotten to. If you figure back on in January, and the difference that you've seen, about 12% here in the first quarter of the year, it's not too bad. It certainly dispels a lot of myths from the bears on which way the market's going. Now, to be fair, we dug ourselves, QQQ investors, we dug ourselves quite a hole over the past 18 months prior to this year. So there's still more to go, but I think the biggest thing, and the reason that I hopped on today, the biggest thing that I'm seeing is just the tug of war between bears and bulls right now. Absolutely incredible. And it's all from a commentary perspective, right? If you really look at the baseline numbers, it's a fairly obvious story, but the back and forth on commentary is crazy. I've really gotten to the point, I don't know about you, but I've had to take a break from a lot of the stock market stuff because it's just the way people talk about things and the way that we're so convicted nowadays, whether it's bull case or bear case, it's hard to follow. It really is. So what I'm going to do today is show a couple things that, to me are probably net bullish, and probably different from what you see on CNBC, for example. And I think the greatest example of that we're going to kick off with today is Micron, who announced their earnings yesterday. And for all intensive purposes, not good, okay? Not a great report, certainly a poor report if you're going to look backwards, right? If you're going to take the report, which is, basically November, December of last year that they're now reporting, it was not good. So let's dig into that for a second. Let me get down to, let's see if we can just get a recap here from Seeking Alpha. Here we go. All right, so Micron pops as analysts realize deeper bottom, but recovery is near, is what they're saying. So if we look at this one, and that's not going to be on there. Anyhow. So you have this Barclays analyst, Tom O'Malley, who has an overweight rating and $70 per share on Micron. So it's good to talk to this person because they were obviously bullish on Micron, and now they're facing what was a subpar performance on the earnings side. We think the stock works despite the reset number, and the name plays into the AI theme that is the real driver for data center business into the next fiscal year. Bank of America analysts, who rates Micron shares neutral, also said there is no quick fix, but it looks like the weakness in the memory market is starting to subside, even if Micron ships less products and loses modest share to Samsung. All right, so kind of a mixed bag there. This is the one that you're going to see emphasized in the news, okay? You're going to see, in conjunction with its fiscal second quarter results, Micron wrote down $1.5 billion worth of inventory, resulting in a negative impact of $1.34 per diluted share. One of the analysts noted that while the near-term environment for DRAM and NAND are challenging, the company may get benefit from reshoring and the U.S. CHIPS Act, given it is the only U.S.-based leading-edge memory producer. So despite terrible results, you still have people who are banging on the phone a little bit and saying, listen, this could be a buying opportunity. As the company manages through one of the worst memory downturns, the team is starting to see some light at the end of the tunnel, with inventory levels continually improving across a broad set of end markets, with a sight towards a bit of demand growth in the second half. What else we got here? We believe this quarter marks the bottom for Micron EPS, and the stock, given DRAM production, is below the demand, which should result in an upturn. We would note the last time Micron had a negative gross margins, it marked the bottom for the stock. So some intriguing call-outs there about, this potentially being the bottom for Micron. And while you would wake up today and probably make the assumption, if you just read the headlines on that earnings report, that this stock would be down, here we are at plus 5%, right? Here you basically have consensus today coming in saying, you know what, that was terrible, that was the bottom, Micron goes up from here. I'm not saying that necessarily. Let's take a look at our earnings estimates. Let's see how bad things could get. So we got fiscal period 2023 that's going to end in August. All right, so starting in September, when I've done this a number of times, when you start to think about the next fiscal year for a company like Micron, it's coming much quicker than many people think. It's going to be over in August, and as far as September goes, you'll be talking about a new cycle. But this year is not good. Minus $3.60. August 2024, across 31 analysts, you got 72 cents. And then if you're patient enough to get to 2025 and you believe these estimates, then you could start to get into much better margins. There's not a lot here on the radar. Okay, there's not a lot here on the radar of EPS estimates that would get the average investor very excited, certainly over the next 12 months. Now, what about revenue? Unbelievable revenue dip this year, $15.62 billion. That's down 50%. Next year, they would grow potentially 46%, but you're still, flat from 2022. So why are people coming out here at plus 5% today and buying Micron? Who's buying it? It's the dip buyers. They're all making the assumption that the future is much brighter than the past. And that is an example of a difference that you would see perhaps from the headlines that are across CNBC that, continue to beat us down with the negative news. Yet somewhere in the market, there's a believer in Micron, and in fact, quite a few, if you go by this. All right, next thing I want to look at here today is the VIX and where that stands. Of course, the volatility index, where that stands in comparison to, the past, in this case, it's the past 5 years, prior to the COVID crisis. All right, you're about in that 17 range for the VIX, and then of course it went up as we went through the drama of COVID, and you had several spikes in there along the way, but from a standpoint of 1 year, you are basically down, okay, to about the levels that we saw of last year, so at 18. Now if we go in the 10-year, let's find our 18. All right, so 18, you were down as low in January of 2017, you were in the 11s. All right, then we had 18, I'm going to say it landed right here. About August of 2019, you're up a little bit. That started to get into a time with Trump and China and interest rates that you had a little volatility and you had a market dip. But, I would say if you're looking for a very settled period, you want this VIX to probably be in the 10 range, 11, 12, something like that. We are a ways from that pace, but year-to-date perspective, we've come down considerably. If you think about the bank crisis and how high it went up, those jitters are coming down right now, and they're coming down fast at, minus 4% today, for example. And I don't know if I can set this up on a chart. If you're not familiar, generally speaking, when the VIX goes down, this is not really showing me what I want. When the VIX, when the VIX is elevated, and this is against the S&P 500, when the VIX goes up high, the S&P goes down, right? And when the VIX goes the other way, and you get a settling of volatility, well, then the stocks go up. So even the short term, let's see if it'll do it. Yeah, here's a better look in the short term, year to date. When you have the price going up plus 20%, then the S&P 500 goes down. Well, now we're in a period, as you can see here, very similar to Jan 12 through Feb 17, where the VIX was falling, and the S&P is going up, and it looks like it's early. It's the first few days of a downtrend, but that is a positive sign, I would say, in general, for the stock market and buying activity. Again, that's a little bit different, perhaps than, everyone's so focused on interest rates that you start to forget some of the other indicators that are out there that are based on real market trends. And that is the key. What is actually happening versus what are we talking about? What are we predicting? It's definitely a fine line these days. All right, I've carved this out, U.S. large and mega cap stocks. I reference this a lot, but let's take a look at year-to-date performance, okay? And I think we all know that at the top of the large and mega cap names, if you're just going to say year-to-date, okay, give it a second to sort. There's 742 stocks in here. But if we go year-to-date performance, and this first name, Wells Fargo, this is not Wells Fargo. It is, but it's a different take. I don't know which one that exactly stands for. But you've got NVIDIA year-to-date plus 80%, okay? NVIDIA past 3 years, 318%. Coinbase, of all things, we know that Bitcoin's going up. Which is this? Symbiotic, I'm not familiar with. It does not have a 3-year history, so it must be relatively new. What else is here? XM, Qualtrics International. You've got Facebook. You have CGen. All right, Tesla's in here. Freaking Roblox is in here at plus 47%. That's coming off of last year's, or a 1-year performance of minus 13%. AMD, okay, again, back into chips, year to date, plus 46%. Over the past year, after this rebound, if you invested last year at this time, in March of 2022, you would be down minus 20%. That doesn't really seem too bad considering the tech stock meltdown that we've had. And if you're a long-term investor, if you bought this 3 years ago, which would have been just coming out of COVID crisis, quite honestly, 103% would be your return. Salesforce, top of the pack, plus 45% year to date. Align Technologies, heck, even GE, okay, plus 42%. And some of these have been winners. So if you go look at First Solar and GE, some of these have been winners not only over the past year, but also year to date and the past 3 years. So let's identify those companies if we can. What's this one? Lattice Semiconductor. If you have been in that, particularly for a long period of time, it's pretty much been green, period. But I never hear about them on TV, right? So what are some other names? Fortinet is cybersecurity. they've been up 230% over the past 3 years. So pretty darn good investment despite the volatility that we've had. Trade Desk, they've been up and down because of advertising spend lately. 191% over the past 3 years. You took 15 off last year, and now you're plus 29. Okay, so everybody ragging on tech stocks, you just have to be careful because what's really happening in the market seems to be different than what's advertised on TV. Okay, Palantir gets picked on, rightfully so, for some of its performance. Last year, minus 40%. That is not good, right? There's no one who's saying that is good. However, this year, plus 24%. And this is the same plus 24% that many say would not happen because government contracts might be drying up in the wake of this economy. Stock-based compensation comes into play with Palantir all the time. Nothing but bad news, but here, if we look at the scoreboard, it's plus 24%. Now let's flip the script a little bit on these large caps and mega caps. I'm going to go worst performers year to date. Okay, so if you are in, let's take this as Monster Beverage. Yep, if you are in Monster Beverage on the first day of trading this year, that is the worst performing stock, at least on this screener, for United States-based companies that have a market cap of 10 billion or more. Okay? Monster Beverage. I don't know a lot about them except for the obvious of what they sell, but you're down 49%. Okay? How about Bank of America? This is another special dividend play on that. Let's see, is this Schwab by chance? Yeah, Charles Schwab, minus 32%. 1 year performance, minus 40%. Okay? Who would have thought, if we go back to Palantir, for example, prior to, we know what's affecting financials right now. But if you were walking in the year and somebody said, Charles Schwab, Palantir, how are we looking for year to date? I guarantee you most of the bears would have picked Charles Schwab, right? Absolutely, for sure. Now, on the other side of growth, here's a company, Rivian, electric car manufacturer. They've failed to produce tangible asset growth at all. So you're going to have ones like this that, they have to put something on the board themselves, and they certainly haven't done that this year. Key Bank, all right? They're one of the big losers. Texas Pacific Land Corporation. Enphase, surprisingly. You get a lot of Enphase fans with solar, and it has not been a good run for Enphase over the past year, minus 27% year to date so far. But if you bought this one 3 years ago at plus 500%, you're probably not too worried about it. Who else is on our year-to-date losers? You got Pfizer. Okay, you have CVS. All of these stocks that a lot of people would have considered safe. PNC Bank. Is that Halliburton? Yeah, that's Halliburton. 1 year performance on Halliburton. If you think back to where we were a year ago with oil prices and what a lot of people, saw as safety with the energy stocks, and they did. Those stocks went up considerably, but now you're down minus 16% on 1 year if you bought it in March of 2022. And it just goes to show you how whipsaw this market has been. And it also goes to show you how quickly opinions change. So, tech's being dragged through the mud, interest rates, all the reasons why. But here we are, if we're going to look at year-to-date performance and some of this safety that's being talked about the most on TV, turns out if you stayed in it for a year, like most people would tell you to, you're sitting down year to date. Chesapeake Energy, you're down 19%. So there's a lot of different ways to look at this market. And, for this quick live stream, I just wanted to come in and call out a few things that I'm seeing. Make sure you're open to opinions, because the opportunities, the real opportunities, can be very, very different than what we're talking about on TV, right? I mean, I don't know about you, but watching every day projections of where interest rates land just really seems counterproductive at a certain amount of time. And that's why, I haven't been posting as much on this channel. It's just like, if that's all we're going to do on TV, and if that's all that people care about is which way interest rates are going to go, and no one's going to buy anything until they get settled, then those people are wasting time, okay? Because there's other stuff that's going on out there. I respect the folks that just, with the way savings accounts are going, I respect the folks that just put the money in their savings account and just walk away from the market until maybe fall. Probably going to miss some opportunity in there, most likely, but I don't blame anyone, because if you go in the media right now, first of all, the media opinions are all negative, and it's tough. It's really tough to prove a case for growth right now. However, you have to keep in mind that growth comes out of places, and stock appreciation comes out of places that you can't normally project, right? So that's the take for today. I hope everybody's doing well. If you're interested in learning more about Seeking Alpha, I have a special coupon for you, special promotion down in the description. Again, keep your mind open. We will see you on the next video.